Coming up on Market to Market, fire rages across the High Plains. A legislative move could drown a historic lawsuit. And using new tools to hedge against catastrophe. Those stories and market analysis with Ted Seifried next.
Some protection.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. This is the Friday, March 10 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. The second warmest February in more than 120 years made for tinder dry conditions across the High Plains. The unseasonably warm weather provided fuel for devastating fires that have ravaged the region. Kansas, Colorado, Oklahoma, and Texas have been swept by wildfires that have wiped out over 1 million acres and taken 7 lives. The fires have charred wheat acres, scorched rangeland, and killed thousands of cattle. The warm weather also has allowed planters to roll in the south. This annual rite of spring ups the ante of nitrate filtration at many water treatment plants. In the Corn Belt, Iowa's largest water supplier has taken farmers to task over the high nutrient levels with a lawsuit. But action in the state legislature may dismantle the case before it ever goes to court. Josh Bittner has the story.
We can work through problems. We have a history of doing it, and I know the local folks can as well.
If Iowa House File 484 becomes law, the Des Moines Waterworks would be replaced by a regional water authority with greater influence from city government and outlying areas. Opponents call the bill a thinly veiled attempt to crush the water utility's historic clean water lawsuit against farm drainage districts upstream of its primary water source. A victory in that case could present burdensome federal compliance for farmers across the nation. Those for and against the state's municipal shakeup voiced their opinion in public comments this week, which flowed mostly toward disapproval.
Taking assets of a public water utility is the exact kind of state government meddling that created the public health water crisis in Flint, Michigan.
We just want to go on record and stress that we believe that the effort being undertaken with this legislation is very consistent with other utilities that currently operate in the metro area.
As written, there is not adequate protection against the potential for cost burden to be shifted to suburban communities.
Regional collaboration is in the best interest of the city of Des Moines and the suburbs alike.
I don't even disagree with regionalization, and I don't think many council members do. But I disagree with something coming from this level telling my city how we need to handle things. We are prepared to handle it.
Water boards are good. They're there for a purpose. It's to keep politics out of the water arena.
You campaign on local control, so let the people decide.
Despite pushback, opposition leaders concede Iowa's GOP majority could likely expedite the bill's passage, but caution against legislative overreach.
I say rise up, you say fight back.
This might be a bill that may be more far-reaching than what some of its proponents think it is. And if we've got something this highly charged, then there probably needs to be some more collaboration with stakeholders.
For Market to Market, I'm Josh Bittner.
Crop insurance has always been a hedge against bad weather, insect damage, and drought. For producers who diversify, there is a new tool in the toolbox for protection against Mother Nature. Colleen Bradford-Krantz has the details in our cover story.
Roger Umler still cringes when hail or windstorms head toward his family's 460 acres of orchards in Conklin, Michigan. But a redesigned insurance program for agricultural producers, called Whole Farm Revenue Protection, has him less on edge in those weeks before the apples, peaches, and cherries are safely harvested and shipped from the Centennial Fruit Farm.
This is still farming, so we kind of accept some risk anyways. So with our whole revenue insurance, We still feel we're taking the risk, but there's still that backing there.
Producers need to sell at least 3 types of crops or livestock to qualify for the Whole Farm Revenue Protection, or WFRP's, highest levels of coverage and maximum premium contribution from the government. Those with 2 commodities are eligible at lower coverage rates. Single commodity producers are ineligible for the higher premium contribution from taxpayers, but can obtain protection.
For those farms that are well diversified, roughly speaking, 3 or more crops, then the premium subsidy rate, the part that the government pays versus what the grower pays, is significantly larger than it is for the standard corn, soybean, and wheat, cotton, and rice policy. The risk for the whole portfolio is less than a risk for an individual crop, and they wanted to essentially incentivize people to consider the product.
Whole Farm Revenue Protection was based on 2 pilot programs that failed to gain widespread popularity in the dozen or so years of their existence. A mandate in the 2014 Farm Bill spurred USDA to launch Whole Farm on a limited basis in 2015. By 2016, the program had been fine-tuned and was made available to producers across the country. The value of the commodities covered under the plan grew 109%, from $1.1 billion to $2.3 billion. But while most states have gained enrollment, whole farm revenue is still dwarfed by other crop insurance programs and represents just 0.1% of the more than 2 million policies partially supported by the federal government. The total value covered by those policies, including the more popular multi-peril crop insurance, topped $100 trillion in 2016. In recent years, Congress has begun pushing farmers toward greater reliance on insurance programs rather than relying on direct subsidies or disaster payments that follow catastrophic weather events.
Congress basically routinely did these off-budget disaster schemes. The argument has been what level of coverage and what kind of product do you have to offer so you're making payments to growers commensurate with what the risk is, not what the deal of the day, so to speak, is.
Umler, who is co-owner of Centennial Fruit and part of the 4th generation to work this Michigan orchard, says the Whole Farm Plan seems to offer a better mix of cost efficiency and protection for the family's orchards compared to other government-supported insurance programs. Unlike insurance programs based on expected yield, WFRP looks at an operation's annual revenue stream over 3 to 5 years. Producers decide how much of that revenue they want to protect, ranging from 50 to 85%, knowing they will pay a higher rate for more coverage. The plan also covers livestock at values up to $1 million. For Centennial, the program takes away the risk of having an adjuster try to estimate yield losses after severe weather damages their crops. Instead, any reimbursements are based on concrete numbers from past tax records.
I think there's the simplicity of it. Makes it work, there's no, it'd be really hard to cheat the system, which is nice, and you can be confident in that. And it's a safety net for the food supply.
Kelly Jackson of Daniels Produce in Columbus, Nebraska, which has signed up for a 3rd year under Whole Farm, says the loss adjusters sometimes lack familiarity with the less commonly grown fruit and vegetable varieties. Jackson, who runs the 500-acre vegetable farm with her parents and brother, says if some produce is still harvested after a disaster, hidden blemishes can hurt marketability. Whole Farm's use of an operation's historic revenue stream helps work around that problem.
In 2014, the year before Whole Farm, when we had that huge hailstorm, we had, I think it was 60 or 70 acres of cabbage just shredded. Everybody had disasters. The adjusters took a good solid 10 days to get out here. And by then, 10 days later, it had started to grow back. And it made heads, but a lot of it had black rot.
The family, who has farmed their land for 4 generations, had already paid crews to harvest the cabbage before the extent of the damage was discovered.
Sometimes all you're doing is going farther in the hole and you don't know it until the dust settles because you're just in it in the moment, and all you want to do is do your best to save your crop.
Daniel's Produce had one of just 10 whole farm policies in Nebraska as of 2016. But those numbers may increase as Nebraska Extension works to educate private insurance companies about the program.
But if you're a field corn soybean person that also they can get this too, and if they're into livestock and sheep or whatever, and alfalfa, that's 3 commodities. But I don't think a lot of people know that this exists because there's not a lot of agencies yet willing to take on the complexity of this.
Michigan State's Black says whole farm revenue also provides some incentive for producers to consider or continue with greater crop and livestock diversity.
But they really were starting from the point of view of what can we do that actually exploits the nature of diversity of crops.
Umler sees whole farm as a way to shield his family's legacy against disaster.
Right now we've got trees ordered out for 2018 and down payments on them. And of course, like any farmer, we have loans out that are due and sure helps with our banking. If we had 2 bad years in a row, we could be out of business here. So to have that backing it's good to know that they're kind of helps protect the family and the business and all the work we put into it, not just my generation.
For Market to Market, I'm Colleen Bradford-Krantz.
Next, the Market to Market report.
The WASDE and CONOB reports did little to hold back falling prices in a commodity market already in a downward swing. For the week, May wheat lost 13 cents and the nearby corn contract fell 16 cents. Increased production and world-ending stocks pressured the May soybean contract 31 cents lower. May meal dropped $4.30 per ton. In the softs, May cotton declined 70 cents per hundredweight. Over in the dairy parlor, April Class 3 milk futures drew back 37 cents. The livestock sector had a positive week as the April cattle contract gained $1.62. April feeders increased $3.73, and the April lean hog contract added $1.43. In the currency markets, the U.S. dollar index lost 30 basis points. Crude oil shed $4.84 per barrel, finishing below $50 for the first time since December of last year. COMEX gold fell $25.10 per ounce, and the Goldman Sachs Commodity Index retreated more than 20 points to finish the week at $378.15. Here now to lend us his insight on these and other trends is one of our regular market analysts, Ted Seifried. Ted, welcome back.
Hey, thanks for having me.
We're glad to have you, but before we get started, you can listen to our market discussion anytime by downloading our market analysis podcast on our website, iptv.org/MTOM. Now, Ted, it was an ugly week in the grains this week. Wheat down 13 cents on the week. Talk to us a little bit about the news that dropped this week in the wheat market.
Well, the wheat one is a little bit interesting because, while there is a little bit better forecast for the plains, you still think there's some pretty good support and pretty good fundamentals for the wheat right now. But the weakness that we saw in corn and soybeans kind of put some pressure on wheat as well. You look at the issues that they're having in Australia. Look at the issues that we're having here. This wheat crop's not going to be nearly as good as what it's been in the past few years. Lower acreage. So, the old adage, and I'm not a big cliche guy, but the old adage of low prices cure low prices, we're kind of seeing that happen in the wheat market right now. So while we did take a step back this week, I think the lows are still in for wheat. I think there's a good chance that over time, wheat longer term looks pretty friendly, and I like the wheat trade going forward.
All right, speaking of looking pretty friendly, we did see a pretty sizable drawdown in hard red spring wheat, and we've got a question here from Kevin in Keldron, South Dakota from Twitter. We encourage all of you to send in your questions via Twitter and Facebook. Kevin wants to know, what's the deal with declining HRS acres, that hard red spring acres?
Yeah, that's a great question. I think price-wise, we see reason why we could add to it, comparatively speaking, but that declining acreage is a concern, and as we were just talking about, low prices are the cure for low prices, and when we have that for an extended period of time, we start to cut out production, and we're seeing that. Okay. So when we look longer term, that corrects this sort of issue. Now, we've got a lot of wheat to chew through in the world, so it might take some time, But longer term, those fundamentals do seem to be changing more positive.
All right, low prices cure low prices. Ted, we're trading 364 where we closed on the nearby corn contract. Are we close to those low prices curing themselves, or what's your thoughts on this corn market?
Well, corn and wheat are the two markets where that adage works. Low prices curing low prices. We're seeing that in acreage reduction both domestically and abroad. So yes, I think for corn we're doing something of that as well. The problem is we still have just like wheat, we still have big stocks to chew through before that really makes a big impact, unless we have a weather issue this year. Stay tuned for that one. But longer term, again, same sort of scenario for corn. You wonder if the fundamentals are now turning a bit more positive, unless we have another record acreage, record yield, record production year. You think that these low prices have built enough demand and that will chew through these ending stocks over time, and there's reason to be optimistic.
Now, record acreage, we did get a report out of South America. They are planting that second crop, safrinha corn. Is that going to be record acreage this year down there in South America?
Yeah, it looks likely. It looks likely. Everything in South America is looking likely like a record, except for Argentina. But everything in Brazil looks really phenomenal. And so, yeah, there's going to be a lot of corn coming online. The USDA production numbers for both corn and beans in Brazil were sharply higher on this report. And yes, there's going to be a lot of competition this year for exports.
Are you being aggressive at any point here in the near term getting corn harvest sales made in that December contract?
Well, I think this is another year like last year where we want to use cash sales to manage our risk, and we want to use call options to manage our opportunity. If we get a chance to sell above $4 corn, which we had, and we did sell some there, if we get chances to sell above $4 corn, in particular 421 is a target of mine.
Okay.
We want to be making cash sales. But in the meantime, while we have this pressure that we're seeing right now, I think it's a good time to come in and buy calls so that we have an opportunity to take part in a weather rally if we get one here this year. There's a lot of compelling things weather-wise that I think it's a really good year to do that. I'm not going to go too far into weather. We listened to that last year, and we all know what happened with that. But even more than last year, I think there's some reasons to think that. And just because of what happened last year is not a good reason to not participate in a rally if it happens.
No two trading years are the same.
That's right.
Now, speaking of no two trading years are the same, last year, terrible year for soybeans coming out of Brazil. Yep. This year, 108 million metric tons out of Brazil alone was USDA's number. How much downside potential is left in this bean market after this week's sell-off of 31 cents?
Oh, I think there's a pretty sizable amount of downside potential for soybeans at this point. Part of the reason why we are, at the end of February, we were trading $1.35 higher year over year. Part of the reason for that is because the South American producer had been well behind on sales. That is in large part due to the late season issues that they had down there, and the South American producer had to watch the market rally $1.80 after they had already made their sales. The other thing was that the Brazilian real had gotten a little bit less favorable for them there since the middle of January. So now that the real has gotten, again, back to the favorable levels, and now that they're getting into harvest, I think you're going to see a lot of these soybeans getting sold off the combine. You could have a tremendous amount of hedge pressure happening here over the next couple of weeks.
Hedge pressure, which could eventually trigger some of those fund sales that we've been seeing them support this market so well.
Right. So the funds are technical traders, and if we start violating some of these key technical support points, you could have funds piling out at the same time, and that can kind of snowball on top of it. And then add into the mix that we're talking about massive increases in acreage for this March 31st report. While I don't think that we'll see that, I think the trade might be a little bit too aggressive on the shift from corn to soybeans. The idea of that, throw that into the mix, and that could mean a lot of pressure here in the next couple of weeks.
So for producers who have not been very aggressive making November bean sales, do you try to front load them here the early part of next week, get ahead of some of this, or do you wait until the March 31st planting intentions report?
Well, I've got most of my guys 20 to 30% sold on new crop beans already. Okay. And we're using a lot of options to do that. In particular, we're putting in a $10 floor. At this point, we do have a very key support point that we might try to bounce off here early next week. If you get that and you get a chance to make some sales over $10 again, I think you do a little bit of that.
Okay.
If not, then you really do look for a bounce out of that March 31st report if you get one, and look to sell that. And last thing I want to say about soybeans, the fundamentals are such that if we are not sharply lower in the next couple of weeks, unless there's major planting delays and we start to do see an issue in South America, but if we don't see an issue in South America and we don't see something big coming out with RFS and renewing the tax credit, if soybeans aren't sharply lower over the next 2 or 3 weeks, then you think something else is at work here.
Okay.
Maybe it's not the fundamentals, but the fundamentals.
Gotcha.
And then you got to start trading money flow instead. But when you look at just the outright fundamentals right now, soybeans should be lower here.
All right, and we will discuss the RFS a little bit more in the Market Plus segment, which you can find on our website, iptv.org/MTOM. Now, Ted, on the livestock side, to the plus this week, we started to see live cattle gain a little bit. How much higher can we push this live cattle market in the short term?
In the short term, cash is held in very well. That's one of the main drivers here. We've seen products selling at highest levels we've seen in a while, so demand up front is really very good. I'm a little skeptical, though. I mean, on-feed numbers are really quite big. Placement numbers are really quite big. I'm a little worried that we're building a big wall of cattle in the back.
Okay. How far in the back? Are you looking midsummer? Are you a little closer?
Midsummer to early fall.
Okay.
I think in the meantime, it looks like, and it was a very good close on a chart, technically speaking, looks like we might want to go test those highs that we've had. I do think there's some short-term upside potential, but these are things that we want to be looking at areas to be hedging and be laying off some of the risk, because we are looking at better prices than what we were looking at 6 months ago, much better. So, I mean, we got to protect that.
$20 to the upside.
Absolutely.
Now, that 119, is that kind of that 119 and change, those previous highs, is that really what you're targeting?
Yeah, the 119, maybe we take a run at 120, but, right in that area, I think we need to start getting sold.
Okay. Feeder cattle up $3 on the week. Makes sense with a big break in corn and that rally in fats. Can we continue to see this run, or does corn have to keep breaking to maintain this strength in feeders?
Well, I think you see a little bit of both. I don't think you see a huge drop in corn from here, because again, the fundamentals for me aren't nearly as bearish as they are in, say, soybeans.
Yeah.
Soybeans might sink the ship in grains for a few weeks, though. So, yeah, if corn does come down a little bit more, plus the chart that you've got for feeder cattle, you could see some more upside potential. But like I said, placement numbers are really quite big, and it's I really don't know longer term if I can be that bullish feeder cattle.
Okay, you're comfortable in here as a seller getting hedged.
Yeah, again, I'd wait maybe just to see if we can go retest those highs again. But that's where I'm comfortable selling, yeah.
Gotcha. Well, now let's talk lean hogs. Again, all over the board. We did finish up this week, that 143. Can we touch that $70 mark in the nearby again, Ted Seifried?
I think we're going to give it a try. I do. I'm not so sure we have a reason to go and see new highs without a big influx of Chinese demand.
Okay.
But aside from that, I do like the hog story. And I do think that we've had our deeper correction. It's gotten actually kind of quiet, which may be signaling that we're getting to the end of this. It could also be a midway congestion point. But I think likely this is kind of where we're going to base out a little bit and then maybe see a bounce and go try, reach up towards those highs again.
Okay. Is the avian influenza starting to influence the pork market at all?
See, I don't think so. I really don't. I mean, bird flu is one of those things that we've sort of become desensitized to.
Okay.
So similar to like mad cow. The first time we hear about something like this, the markets have a big reaction to it. But at this point, we've heard of them so many times, and they haven't ended up having a huge impact on demand or supply for that matter. So until they actually become a big deal that is impacting balance sheets, it's tough to get excited about something like that. I mean, it's certainly, for hogs, it's certainly not a negative influence.
Okay.
But I don't think
neutral, maybe, as it stands today. Right. Well, Ted Seifried, thank you so much for taking the time to join us this week.
Pleasure's mine, bud.
That wraps up the broadcast portion of Market to Market, but Ted and I will keep that market conversation going, including answering more of your questions during Market Plus, which is available on our website. Now, Market to Market may be airing in different time slots due to PBS fundraising. So if you find value in our program, please consider making an investment in this program, in this service that provides you with the news and market analysis you've come to know and trust. And join us again next week when we'll explore how a lunchbox staple is getting an out-of-this-world makeover. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.